All right. So, yes. So now we're gonna go ahead and show you the allowance method. So, again, because this isn't part of the book, it is something that I have to actually create. So we're gonna go a little off the books for now, but this is actually good. A good skill to know, especially when you're dealing with customers that don't pay you. What do you do? All right, so let's go ahead and create a transaction. I'm gonna go ahead and pick up Mr. Bob Mason again, since he since he has it seems to us that he has a lot of transactions with us. So what I'm gonna do is I'm gonna go ahead and create an invoice for Mr. Bob Mason, and I'm just gonna go ahead and just throw in random things that he bought from us. Okay, so again, he is San Jose. San Jose. All right, and I'm gonna say maybe he bought this back in January of 2019. I'm gonna say January 2nd. I don't know, something random. And this time we're going to create this invoice as 2019 120, just because I don't know what number is the last invoice from that was. Okay, so there you go. I create a random one. All right, let's go ahead and say he bought outdoor photo shoots. Okay. Okay, and he requested, I don't know, let's say 3 hours worth of it. And then he also bought a standard photo package. All right, and he bought one of those. All right, so again, because a standard photo package, all right, so here everything looks good, everything's calculated, no, he does have terms. Again, thank you for your business. My memo here is going to be 3 hour outdoor photo session and one photo package. All right, there you go. Everything is taxed. He's taxed at at Santa Clara. Everything looks good. So he owes a total of $344.54. So let's write that down so we can memorize that. So $344.54. Okay, now we could go ahead and save this and validate that this is a transaction that existed. So now that's in the system, right? Now, first things first, as we mentioned before, in order to create to actually do the bad debt, you need to have a bad debt account, and you also need to have a bad debt item. So because this is something that we've never seen before, we got to go back and start from square one, because if Mr. Bob Mason decides to just not pay us and just ghost us and not give us a notification why he's not paying for this bill, then we got to make the standard procedures and set up the necessary things that we need to have in order to properly write off the bad debt. So with that being said, we're going to go ahead and start off by creating a account that reflects where everything's going to go into afterwards. So I'm going to go ahead and create a new account because I know for sure this account does not exist, okay? So new. All right. So instead of making it an expense account, right? When we learned this in accounting, we learned that this is an actual contra account to an asset. So it's a contra asset account. It's not an expense account. It's only later on we realize that when we actually write off the bad debt, we need to actually transfer whatever amount it is and drop it into the bad debt expense. So the bad debt expense account, which already exists, is still going to be used, but we just have to have another initial step. So it's not an income and it's not an expense account. Technically, it's not going to be also it's not going to be a bank account. What it's actually going to be is it's not an accounts receivable because that increases it. It's actually going to be categorized as other current assets or other assets. I'm sorry. Or it could be other current assets. But in this case, I'm just going to go ahead and put it under other assets. Okay. And then I'm going to go ahead and click continue. So now it's going to, there you go. Now it's going to say, well, what do you want to associate this other asset account to be? And we're going to name it our allowance for doubtful accounts. Okay. Allowance for doubtful accounts. Okay, it is not a sub account for a pre-existing account. What this does is it's collecting. Oh no, wait. Writing off uncollectible debt. Okay, straightforward. Nothing else that needs to be account number. Now again, I didn't take a look at what account numbers exist, so I'm going to go ahead and click save and close, and I can always edit that account number later. So when it's now dropped out in here, we can see that the other account numbers start off with 18,700, and then the one before that is 17,000. So I'm going to go ahead and double click that, and not double click, I keep making that mistake. I'm going to right click it, and I'm going to edit this account, and what I'm going to do is I'm going to create this as 18,000 since it doesn't exist already. And then I'm going to go ahead and click save and close. So now 18,000 is going to be my allowance for doubtful accounts. Okay, so I have an account that exists. Boom. Okay. So now that is there. Now I'm going to go ahead and create my line item or my item that I'm going to use in order to place the amount there. So I'm going to go to here, create new item, as we remember from the previous example, except this time it's still going to be an other charge, but this time it's going to be the allowance item. Okay, so again, I'm going to type in allowance for doubtful accounts. Doubtful accounts. All right, description is to write off uncollectible debt. Okay, and then what account are you going to link this to? It's going to be the one that we've created just recently for the allowance for doubtful accounts account right there for the 18,000. Of course, no percentages or no number that's involved. If it's taxable, you can again overwrite that. So now that my item is complete, I'm going to go ahead and click OK. And here it is. It pops up right here as the allowance for doubtful accounts item. All right. Now we are ready and we are set to go ahead and write off bad debt. Okay, so I'm going to go ahead and go back to my customers, and I can go ahead and click on Bob Mason, and I'm going to go look up that little form that I wrote for him, which was the 2019-120. So here it is. Okay, and let's say he does in fact not pay for this or something happens, I'm going to go ahead and click on my returns or refund/credit. And here it comes up with a credit memo. All right. So again, associate this credit memo with the number 1020C, okay, for credit. And this time I'm going to change the date because it's no longer January. It's actually, the transaction now is going to be February, and I'm going to make it a little later. I'm going to make it February 25th, okay? That he decides to tell us that he can no longer pay for this anymore. So here now we have, we're a little in conflict now because now we have two items that exist right here. But what you can do is, again, you can combine them. They don't have to reflect everything that's in here because, again, a credit memo is just going to, or not a credit memo, a bad debt item is just going to zero out your entire amount. So in this case, I'm going to go ahead and clear out this item because we don't need it anymore. Okay? And then I'm going to also clear out this item because what are we going to, we're going to actually utilize the allowance for doubtful item right here. Okay? And of course, it's, there you go, to write off bad debt. We're going to leave this as non-taxable because instead of actually like toggling what is what, you can go ahead and enter in the full amount for whatever the amount is for. So again, you're going to have one item. Actually, wait, you can't do this because the tax is there. So you're actually going to have to create two items. So one is going to be allowance for doubtful. The second one is also going to be allowance for doubtful. And I don't actually know, I don't remember what the photo, how much the photo paper was. So I'm going to go ahead and minimize my window. Oh, not that one. I'm actually going to minimize my credit memo and try to look at my invoice and determine it that way because this is a taxable item. So it's $55 and it was taxed. So $55 is going to be taxable. So here I'm going to replace this one for one item and I'm going to label it as $55. Okay, so that's going to be taxed $55. And then the remaining amount here, I can go ahead and indicate that the total that was there was $285. Okay, so one item not taxed is a total of $285. Where my one item, which is my photo paper, was $55, but it was taxed. So by looking at, just to make sure that this calculation is correct, $344.54 is your total amount that you're writing off for the bad debt. And I went ahead and I labeled each item is going to go directly to the allowance for doubtful accounts item. And here I'm going to go ahead and clear this little memo and actually say that this is actually going to be to write off bad debt. Okay. All right. And then I'm going to go ahead. Everything looks good. The tax is there. And I'm going to go ahead and save and close. And I'm going to apply it to an invoice. And then it's going to automatically pull up, well, which invoice are you applying it to? Now, remember, Bob Mason is a very popular person. He's been, he's a good customer of ours. And he has many invoices that are still open. Well, in this case, I'm only applying it to one. And that's going to be for the invoice number 120. So there you go. It's been highlighted. And I'm going to go ahead and click done. Now the invoice is going to show up again. And this time it tells you right here that the total is going to be for the 354. The applied credit is going to be for the 354. So therefore the amount that is actually due is going to reflect as 0. Okay. So that's how you do that account. And I'm going to go ahead and save and close. So there's how you do a credit memo utilizing the allowance for doubtful accounts. Now, if I go to my chart of accounts, what I'm going to notice is that if I go to my allowance for doubtful accounts and double click this, I will automatically appear up here that I have a total quantity of $340 in my allowance for doubtful accounts, right? Why is it $340? Because again, it also includes sales tax. It's already been taken out, okay? So that's one of the things that you will not see is that there is tax been taken out on another account, okay? The only thing that we're looking at is that we only see the $340, which is the actual amount that was actually billed for. But again, we didn't collect the tax, so therefore there's no purpose to include the tax, okay? Because we never collected it in the first place. So there you go. There's this one, okay? And of course, the one thing that we did earlier was the bad debt item. If I were to go look up my bad debt real quick. So, expense, bad debt right here. If I go ahead and double click this, again, it's going to show me a quick report. So if I go ahead and toggle the dates here, because that's what's most important, is that you want to make sure that the dates are toggled correctly. And we'll talk about that in reports in chapter 6. So, again, that transaction actually happened, I believe, February. Okay, so if I go February 1st all the way to February 2019, there you go. And I go ahead and click refresh. Here, it shows me that I have a credit memo written out for the Anderson wedding for the amount of the full $190. Okay? Boom. That's how you go ahead and see where your bad debt is. Okay? Now, the next step that you're going to actually do is, because something that we're going to learn in chapter 13, is that when you actually make your adjustments, which recording the bad debt is going to be considered an adjustment entry to us. So in chapter 13, what happens is that now, when we actually have an estimated amount of bad debt that we're actually for surely permanently going to write off, that's where we're going to create a journal entry. So I'm only going to briefly touch upon it. I'm not going to do it just because, again, it is something that you do in chapter 13. But when you go to company, you're going to actually create a general or make a general journal. And this is where you go ahead and actually make your journal entry in to complete your bad debt expense. Okay? If you guys remember, you debit your bad debt expense account and you credit your allowance for doubtful accounts. So for whatever it is going to be, whether it is an estimated amount, whether it's the whole amount, portion of the amount, this is where you're going to create your adjustment entry right here to completely write off the entire bad debt amount. Okay? Again, I'm not going to do it today just because it is something that we learned in chapter 13. Okay? Any questions on how we wrote bad debt off, or any questions in regards to just bad debt in general? Okay?
Not right now.
Okay, so there you go. We got to look at how to become a tax accountant, and we got to look at how to become a regular accountant. Okay, so with that being said, next section we have here is going to be customer statements. Of course, if you have a bunch of customers, your number one thought is if they're going to have a trail of transactions or they are a returning customer, you always want to be generous to send them a current balance statement. So that is what this whole section is about. especially if you're invoicing and you're expected to have your invoices due at the end of the month. Maybe they bought something in the middle of January, right? You can give them a little January statement saying, hey, don't forget, you still owe us money. So it's kind of a reminder as well, but it also allows the customer to kind of see what they ordered from us, but it also gives them a description of exactly how much they owe us. So that is what a statement is. It's basically basically a list of activity that a customer has, and a list of transactions that the customer has done between us and the customer. So typical, often ones that you would normally see is if you owe, or if you own a credit card, that's the first thing they're going to send you. They're going to send you a credit card statement. It's going to list every details of all your transactions that you've incurred that past month. It's also going to enlist any, fees or any, interest that they're going to charge you for. So for example, if your credit card allows you to have open purchases, or even second one allow you to do cash advance, those are two different types of rates. So they'll list it all out for you, and that's exactly what we're going to be doing here today. We're going to go ahead and show you how to do that. So the first thing you're going to do is it's going to be on your home page, statements, under the customer section, which is the middle section. You can also create customer statements in the customer center. You can go ahead and right click them and be able to create a statement. I don't think you can do it through here though. No, you can't do it through the manage transactions or the new transactions at top, but you can definitely right click them and create a statement that way. And the menu bar, I don't believe you can create statements on the menu bar. Let me see. Customers. Oh, yes, you can create statements using the customer menu bar. So there's only two ways that you can do it. I mean, three ways. You have the menu bar, and then when you're in the customer center, you just right click on a specific person and create the statement, or you have the home page. Okay, so let's go ahead and create our statement by selecting statements on our home page. So this is what it's going to look like. It's going to ask you a bunch of questions, so you can either create the statements not just only for one particular customer, but you can create them for all, okay? And that's what typically credit card businesses do. They don't just send one letter to one person, they send them to every single person. But there's also rules and filters that you can do that allows you to either, send statements to specific people. And especially if you have people who don't have any account balances or bought something from you like 2 years ago, you're not going to surprise them with a statement saying, hey, guess what? You have zero balance with our company. That's a waste of paper. It really is. And that's a waste of mailing out, something like that. So, general rule of thumb is like you definitely don't want to send any statements to anybody. You want to actually filter them out and actually choose which customers that you actually for surely want to send them out to. Okay. So go ahead and starting from the beginning of the very top here is going to be, what is your statement date? So this is always going to be reflecting at the end of a given either month or period, depending on how often you send out these statements. So for this example, we're sending out quarterly statements. Now, this statement here is always going to be reflecting at the very end of the month, because you always want to make sure that the customer knows that this is their transactions that they've completed by the end of this month, or, including this month, I should say. Okay, so in this case, I believe the date here is going to be March 31st of 2019. Okay, that's the statement date. That means any transaction that can happen between a given amount of time, but this is the last day of that statement date. So I'm going to choose March 31st. And what this statement's going to entail is going to entail all transactions that happened between January 2019, okay, 1st of 2019, all the way till March 31st of 2019. Okay? March 31st of 2019. So there you go. So now I'm giving quarterly reports on every single transaction that has happened. So again, this will include invoices, payments, credit memos, returns, refunds, whatever it is. It's every single activity that has happened between the customer and you. All right. So then now that we've toggled this and we've figured out what this statement date is, now we can go ahead and go through our criterias. Okay. So the first criteria is, are you going to send it to all of your customers? Yes, you generally would want to do that. Okay. So you definitely want to make sure that you send them to all of your customers. Hold on. Okay, sorry about that, guys. Okay, so going back to this, here we are. We're looking at your statements and who you want to send them to. Yes, you generally want to send them to all of your customers, okay? You never want to you don't want to pick one person and completely forget about another. You definitely want to make sure that you send it to everybody, okay? Now, you can also pick and choose your type of customer. So if you have a customer type, remember when we talked about it, you can have a commercial one, a residential one. Maybe someone who used to, what do we call those? Like veterans, they get a special privilege or a special rate, or they're possibly part of an organization. Okay, so you can also select based on those kind of customers that way, or you can actually pick and choose your list of your customers. You can even send it to just one customer, right? If you're currently working on this person's transaction and all of a sudden you're like, okay, I'm going to go ahead and send them a statement because I'm already working on them. Then you could go ahead and create that one person, okay? And then that, again, customer types, okay? So we talked about that for a second, like if they're commercial, if they're, an individual, if they're residential, retail, referral, wholesale, whatever category they belong to. You can send it to just a specific group of people. Or if you'd like to, you can also, actually, no, those are the only options. So you have either all, send it to multiple people, send it to one, or you can send it to a certain group of people. In this case, I'm going to make sure that I send them to every single person. Now, again, preferred sent method is usually going to be, you're going to send it through mail, okay? Unless they subscribed or they notified you that they wanted to have it sent to their email, then yes, you can do it that way as well. But this one, it's going to be straightforward. It's going to send them to their mailbox. So now that we have the people that we're going to be sending them out to, the next side is the right side is going to be the details that you're going to have that's involved on to the statement, as well as what exceptions are you going to, eliminate. So the first section here is what template are you going to use? Obviously, this, you can create your own custom, statement that's tailored towards your company per se. But in this case, I'm just going to use the Intuit standard one. All right, now create one statement or per customer. Yes, you don't want to send other customers their information. You want to make sure that you create one statement per customer. Okay. Now here's the thing. Do you want to show invoice items and details on the statement? Yes. You definitely want to make sure that your customer doesn't get confused. You definitely want to make sure that they understand what was the details in their package that they bought from you, or what services was actually provided. The indoor photo shoot, okay, what does that entail? Okay. So there you go. You definitely want to have details into every transaction. Another one is print statement by billing address, zip code. Yes, you definitely want to print that out. Okay. Other stuff too is you want to print due date on transactions. Yes, you definitely want to make sure each person knows when their due dates are. That's a must. Okay. Now the next section is going to be criterias or exemptions, and we'll talk about that in a second. So the first one is going to be, do not create statements for people with zero balances. Yes, we talked about this. You don't want to bother somebody who bought something from you 2 years ago. If they have a zero balance, don't send them one. So again, I'm going to go ahead and select that. So do not create statements for people with zero balances. Do not create statements with a balance less than. No, we don't want, that you should be able to do it with a balance, whether if they owe you $1 or not. Then do not create a statement with no account activity. Yes. If they haven't been active in your accounts or have anything, you don't want to create a statement. That's a waste of paper. All right. And then lastly, do not create a statement for the inactive customers. Yes. Again, if you've already figured that this person has been a customer for you 5 years ago, you definitely don't want to send them a reminder saying, hey, guess what? Your account balance is still 0. That's another waste of paper. So you definitely don't want to do that. So once my criteria and everything I want on my statement to entail is all set into place, I can go ahead, either print them or I can preview them. So I'm going to go ahead and click preview so that I can go ahead and make sure this is exactly what I want. And what you're going to notice, there's a total of actually 3 statements, or 3 people who have either account balances or activity in our company. So again, we have this one is going to be, what does that say? Miranda's Corner. Miranda's Corner is one of the first ones, and let's see if this person owes us anything. In this case, they owe us a grand total of $1,000 and 191. So they still owe us a lot. Okay, and they asked it, yes. Okay. Other than that, we can go ahead and move on to the next one. So this one is going to be Maria Cruz. She's quite active in the Academy Photography. And let's go ahead and look at her details down here. Here, she still owes us $3,000. Okay. And then lastly, we have Mr. Bob Mason. Again, his activity is, we do a lot with him. So we can go ahead and look at here, and he still owes us a mere $700. Okay, as you can see here, the details is very important on a statement, right? You want to make sure everything goes through, and this is what I was talking about when you enter in details in every single form, especially on a sales reform, okay, or a sales form. The memo is very important because, look, it brings it down here saying, well, this is what happened, okay? And again here, as you can see very, very carefully, to write off bad debt, which is what our memo was. And look, it shows that we entered in a transaction, and it shows us that we also credited the account. And the memo that I wrote here to write off bad debt appears on the statement. So you want to be very professional when you write your memos and make sure that they're clear. because if it does end up being on the statement, you don't want to put jargon or put code numbers because no one's gonna know. Not a customer's not gonna know what code numbers you're using. So if you are using a code number, I mean, for your sake of your system, just make sure that you're ready to explain it to a customer when they call you. Okay, so that is what you can do for statements here. Okay, so we got 3 total statements: Miranda's Corner, Maria Cruz, and Bob Mason. Okay, and then I'm going to go ahead and close this window because I no longer need those statements to be available anymore. Okay, so once we've done that, now, if for any reason that there's something that you need to add on to the statement, again, you can modify it by customizing it. You can have things appear on certain sections if you need to by customizing the actual statement form. But this one's a pretty straightforward standard one. It shows you pretty much the details that you need to have that needs to be sent out. Okay? Any questions on creating statements? Okay, let's see if we're good on time. Good, it's only 3:30. So with that being said, the next section is going to be financing or assessing finances, okay? Now, if you have that type of particular finance charges, what this really entails is if you give them a credit card, okay? Because what you can do is you can charge them interest at any given rate. So for example, if these bills, right, even though they have a due date on them, they're expected to pay them within 30 days. But if you give them a credit line or a credit card, right, and they have the option to finance where they make payments every month, this is where you are able to toggle it and be able to charge interest on top of what they owe. So this is actually more applied for a credit card type of business, and especially if you have that type where you allow someone to owe you money and you give them a credit line of $8,000, then therefore they can be subjected to interest because you're letting them have an advance payment, or in another sense, you're letting them borrow services from you and they have to pay you back in a timely manner. So in this kind of case, because we're just going to assume that everyone has a credit card or when they're having an account with us, the assumption is like, I don't know, for example, okay, this isn't real. For example, because they have an outstanding balance, if they don't pay that balance within a certain given time period, they are subject to get charged with an additional interest, okay, that they have to pay on top of what they owe. So again, this isn't a good example because this one is a straight bill, invoice, you need to pay now. This isn't giving them an account and they can charge all they want and pay us back slowly. But let's go ahead and just imagine that these people have accounts with us and they can choose the option to pay us every month or finance their charges. Okay, so each person has a $8,000 credit limit, and because this is a it's a quarterly statement. Now that each one has a statement balance, which we just looked at, Miranda owes us $1,000. We got Maria owing us $3,000, and we got Mr. Bob Mason owing us $700. So that's where we're going to go ahead and click on assess finance charges. Yes. Okay. So what's going to happen is this window is going to pop up. This window looks familiar, right? This window, you can also adjust this, or actually toggle this by going to your edit window. I'm sorry, edit menu and preferences, and that's exactly where you're going to. You're going to go to finance options or finance charges. Okay. Other places you can also see this is actually going to be on the home page. Oops, sorry about that. Let me hit the wrong title bar again. So you can actually see this on your home page right here under statement charges. This is where you can actually either apply the charge, or you can actually manage it by figuring out what your finance charges are going to be. So you can also do it this way as well. Okay. But when we're looking at this, so here is here's the overall outcome. Now, it is actually illegal to charge this person that much interest and that person this much interest. It needs to be a uniform one because it's a company policy. If you allow everybody to have a credit limit of $8,000, of course, with that, you can build your credit. Of course, someone can have a $10,000 limit. Someone could have a $25,000 limit, right? Depending on how well, you judge them, and if they make their payments on time, then you can go make that executive decision. But in this kind of case, you need to make sure that you apply a certain percentage of interest that's going to be charged overall based on the account balance that they owe. So in this case, we're going to go ahead and we're going to go again, assess finance charges. Here we are at this window. So now we're going to go ahead and look at how we're going to charge our customers. So first thing is annual interest rate. Now this one, Academy Photography only charges 10% a year. Now that's actually pretty low. That's a very, very, very low interest rate. Okay, I don't know, but for me, the most expensive store credit card that I own, its interest rate is 28.9%. So someone who just charges 10% a year, they're being very, very generous. Now, oftentimes, most credit cards or store credit cards, their minimum is usually anywhere from 24 to 30%. Whereas other credit cards, such as bank credit cards, those ones can vary from anywhere from, I believe 14 is like the bare minimum, all the way up to 30%. So they can charge a lot of interest, and that's how these kind of companies make their money. Okay, especially by allowing the opportunity for someone to owe you money. Well, heck, that just because you owe me money, there's a condition that comes along with it. You're also gonna pay me interest on top of that because I let you borrow money. So that's where a lot of the companies make their money, is based off of the interest. And this is actually going to be considered interest income to your company. Okay. So again, minimum finance charges. I believe the book says it is. Let me see. Finance charges. I know it's 10% interest. I think it's $1.
1%, yeah.
$1. $1. $1 is the minimum finance charge that they're going to set out, meaning that's the minimum payment. Well, that's not good. Usually minimum payments start off at 25 because usually it reflects your percentage. So in this case, if you charge 10% a year is $1, right? 25% is usually $25 minimum. But in this case, it's $1. That's very low again. And then grace period. So yes, grace period. So when you first open up an account, you have what's called a grace period. You don't get charged financially unless when you actually work out a deal. So this is where the whole 0 APR for 12 months come into play. This is your grace period. This is when you don't get charged interest until that time has passed by. In this case, what is the grace period for this one? Is it 0? I think it's 0.
Yeah.
I'm not gonna give you no grace period. You're gonna put us on an account, we're gonna charge you interest immediately. The day that you start charging the account. So no grace period here. And again, finance charge account is going to be, you're going to get your interest income. Interest income, right? It's revenue to you because you're receiving money apart from your actual core main business. You're receiving money based off of people owing you money, so they pay additional on top of that. So once you've set that up, then the next section is going to be, when do you want to assess these finance charges? You want to assess them on everybody, okay? On the due date, okay? Or even if you like to, on invoice and bill's date. So when the bill is due, you charge them. No, I'm going to do it on the due date, okay? And then last one says, mark finance charges interest to be printed. I mean, that's up to you if you want to mark that that financial charges on the invoice is actually going to be like printed on the statement or not. I'm going to say yes to that. Okay? Then we can go ahead and click OK. Now, another window popped up. So here is all of the current account balances that are overdue right now. So again, we have Cruz Maria, we have Bob Mason, and we have Miranda's Corner. They all have overdue account balances, or they have some kind of account balance. So, okay, Maria Cruz itself doesn't have one, but under her name is a branch opening. So yes, so she's going to get charged no matter what because it's still linked to her. Okay, so again, now that we did this, because we set 10% to be our annual charge, because this is a quarterly, of course, QuickBooks is smart. It took the percentage of 10%, divided it amongst the months, multiplied it however statements there are. So again, 3. So it's already calculated it for you. So you don't need to sit there, calculate what 10% divided by 12 times 3 is. It does it for you. You don't have to do anything. So there you go. Good job. No math is necessary for QuickBooks. It does it for you. So as you can see, Maria Cruz branch opening is going to get charged $600 of interest. Mr. Bob Mason's going to get charged an additional $149. And then we have Miss Miranda's Corner is going to be charged a $230. Now that's high interest, okay? Now imagine how much it's going to be if it's like compounded or whatever it is, okay? If it's done every day, then interest is going to accrue. It's going to be a lot more. So with that being said, those are the finance charges. And what you're going to do is you're going to go ahead and assess these charges. So by clicking that and you get that beep of approval, now if you actually go ahead and view your statement balance, they're all going to look different because now that you tacked on an additional fee that they have to pay, it's going to be reported on here. So instead of just having the total amount of so this is what Miranda's Corner. So at first she owed us $1,000. Now she owes, oh, that's Bob Mason. So yeah, Bob Mason, is this Bob Mason? Okay, yeah, Bob Mason. There you go. The assessed charges was or the amount it was charged was the $700. And yes, the interest should have been applied. Where is it? I don't see it either. It should have been applied because I already charged it. Oh, okay, so here, let's see, Maria Cruz. This is Miranda's Corner. I don't see it either. It should have showed up. Well, that's what the book says. Assess charges. Where is it?
This finance charge.
Oh, okay. Showed up on yours. Okay, so good for you. It didn't show up on mine. Oh, because it's when I print it, it shows it up because I selected to put the financial charges when you print the form. Okay. Yeah. Now I see why. Because I didn't print this, so it won't show up on my end because I selected that I wanted to be printed. Okay, so I'm gonna close this window and maybe I'll reset that real quick. See if that will show up. Okay, I'll cancel or actually mark all undo settings. Okay, so if I unclick this, mark finance charges invoices to be printed. So if I unmark that, click OK, and then click assess charges. I don't know if it's going to do it. Okay, no. So then I'm going to go ahead and click cancel and see if it shows up now if I preview it. Okay. Did it not go through? Well, I mean, if it showed up on yours, then you did it right. Because I followed every step in the book, so I don't know why it's not. I don't know why mine's not following through, but could be an error on my end. But yes, once you click that assess finance charges, it should show up on your actual statement saying finance charges, and it should charge you for the amount, and this number should actually increase by whatever amount that was agreed to be financed. So, yes. Any questions in regards to tacking on interest or anything like that?
No.
Okay.
No.
All right. Okay. Now, last thing that we're going to be looking at, actually second to last thing, is going to be setting up or collecting sales tax. So we talked about this a lot. We talked about setting up our sales tax items. We talked about where these, like how to set them up and which agency you send them to. It's the same straightforward. So as I remember, as you read through this book, it pretty much gives you a step-by-step things that we've done already in class. But I am going to go ahead and go over it, just a quick review. So the first thing it says that if you are potentially selling items in QuickBooks, or selling items in your store, and you are potentially going to have sales tax, number one thing you got to do is you got to activate your sales tax item. Okay, so again, you can go do that through the edit preferences, or you actually have an option right here where it says manage sales tax. You click that, it's going to give you this window, and basically what this is just to help pay or to go set up preferences as well. So I can go ahead and click this, and here is my edit preference window. Okay, so again, because we did select that we do charge sales tax, this is where you actually set it up. So by me clicking no, that whole entire section is going to just it's going to disappear. But in this case, I am selling products and I do charge sales tax. Now, this is where it's going to ask you a couple questions. Did you create your sales tax item yet? Okay, we'll talk about that in a couple minutes after this. But no, I haven't set it up yet. Now, what is your most common sales tax? So again, when you have a sales tax code or a sales tax item, you're often going to see, well, where is your store location? Because this is what's going to automatically appear on every single invoice, or more particularly for your sales receipt, right? People who pay at the time of purchase. Then you want to make sure that you set it to the actual store location. So in this case, it's Contra Costa. Okay, that's the actual store location. So anybody that does business and comes to my store, it's going to automatically associate with this one. And again, these are going to be part of your items that you create. So this is the most common one that the book says that you're going to use. But for us, right, we live in Nevada, so we're going to assume that it's going to be Nevada state tax. And because we live in Clark County, my automatic common one I'm going to use would be Nevada state Clark County. Boom, sales tax. Okay. But this is just for the sake of this scenario or for this company, right? They commonly have it in Contra Costa. Then the next section is going to be assigning sales tax codes. So again, when you are doing regular business, okay, usually, so when we talked about sales tax codes, it's basically you can define what items are either taxable, non-taxable, or, government tax, service tax, those kind of things, right? But in this case, I only, for regular tax items, it's going to be taxed at regular tax, okay? I'm going to name my tax code as just tax. So that means when I associate this item is taxable, it's going to be for this particular location, okay? Now, for non-taxable items, right, you can either have a service as it, or you can have NFP, which is non-for-profit, XYZ. If you are a potential place that does sell groceries or foods or anything like that, that's going to be considered a tax code that you can apply. Because remember, you can't charge for food. You can't charge sales tax on food. Food is free or it's non-taxable, okay? Services are non-taxable. Anything that has to do with that, but anything that's got a long life, something that you use, or again, you can even set a special tax for things like alcohol and things like tobacco. Remember, they have a different sales tax that you have to charge because it's higher than a regular item that you buy at the store. It's going to be charged. I think they're anywhere from 30 to 40%. Okay, so you can set those kind of taxes as well. So then you can have those as part of it. But for this one, I believe for this particular scenario, it is going to be SRV. I think the book tells you that there's one called RFR or something like that. Let me go ahead and double confirm. Let me see. It is SRV. Yep. I got it for here for SRV. So again, because our primary purpose in this thing is that our non-taxable item is going to be, again, SRV. It's a service item. Okay. Once you've done that, now the next section is, well, where are you going to be, so when do you owe sales tax, or when do you often pay it? Okay, and then of course, it says here as of invoice date. So again, as soon as in parentheses, it says accrual basis. So as soon as a transaction has been completed, or as soon as a sale has happened, you're going to go ahead and owe the sales tax. It's going to be collected right away, and it's going to be placed in the sales tax account. Okay. And then it says right here, the other option is upon receipt or payment. So again, if you're doing cash basis, right, you normally don't collect sales tax until it's been paid. But in this case, since this is automatically assumed that it is on an accrual basis, you definitely want to make sure that you calculate the sales tax immediately when the transaction has happened. Okay. And then lastly, how often do you pay this sales tax? Well, for small companies, you can pay, and you can get away by paying every month or every quarterly or even every year. Okay. For corporations, I believe theirs is within the next week. I think it's 7 days upon the actual sale. So it's every week that they have to pay their sales tax, just because, again, that's like the easiest form of money that the government can collect. And if you're a corporation, you can only imagine how many sales is going through every single day, whether it's cash or accrual basis. Okay, so again, in this one, I'm going to choose monthly. Now, every tax item, or every sales tax item that you create is going to associate which agency you're actually going to make a payment to. So again, every item that you pay, or every sales tax item, it's not necessarily all going to be in one agency. There's going to be multiple agencies that collect it, especially if you're doing business out of the state. Okay, so for example, this is a California state. If I charge tax in Nevada because someone ordered something from me in Nevada, I gotta go look up where their agency is and I gotta go pay them. Okay, so that is going to be the concept there. Okay, so I'm gonna go ahead and click OK. Once that's set up, now this is the part where you can actually make payments to your agencies and whatnot. But I'm gonna go ahead and skip forward because again, we're not primarily in the business of understanding truly how to pay them, because it's pretty straightforward. You collect the money, you pay the agency, boom, it's done. Just as simple as that. So there's really no point to really show you because it's pretty much the same standard thing that goes on. Okay. However, now that we've set up our payroll, I'm sorry, I keep saying payroll. I don't know why. Yes, it's about time. Okay, so after setting up your sales tax, right, where, when you're going to collect it, what's your often one that you're going to be using, that's where you're now going to go ahead and create your sales tax item, which we got to take a look at that in chapter 7. We got to look at if there's two agencies that you have to pay, right? If your state is going to be separate from your local, you need to create two separate tax items and then use a sales tax group item to charge the overall agency. To charge the overall customer for the exact amount of sales tax. However, at the end of the day, when it comes to your annual due date, your monthly due date, that's where you make a payment, and what's going to happen, it's going to separate one check for the amount that you owe to the state, and it's going to print out a separate check to print out and send it to your local agency. Okay? So again, we can go ahead and practice real quick on to create a sales tax item for Alameda. So let's go ahead and do that real quick. So how do we create a new item? Mm-hmm. Yep, click new. And then we're creating a sales tax item. So in this case, because the agency and the the county and state are going to be located in one, we can safely go ahead and create just one item. All right. So in this case, in your book, it says that we're going to create a new item, and this one is sales tax for 8.75%. And this one's going to be Alameda County. All right, so I'm going to go ahead and title my sales tax item as Alameda. Alameda? Is it MEDIA or M-I? A-L-E-M.
A-L-A, I should say. Allah.
A. L. L-A. Okay. Oh, wait, that's a J. Oh, Alameda. There you go. Alameda sales tax. Okay, there you go. I'm even having difficulties typing. So there you go. Sales tax is the description. There's really no much that you can do there. So again, what percentage is it? It is going to be 8.75%, which is pretty high. And then again, now it's asking you what tax agency are you going to actually be mailing out this tax to. And that's going to be State Board of Equalization. Okay. So with that being said, obviously because this State Board of Equalization is a vendor that already exists. So if you are looking into potentially doing all this stuff, you do need to make sure that you do talk to your local county about what taxes and where to pay them, so you can set up a vendor profile for them. So when you make payments, it's going to send it directly to that location, right? You have the address already set there. So when you make a payment, it's going to automatically send a check right to that location, okay? And it's always good because the thing about QuickBooks is it will always give you a reminder of when you have something that's due, all right? And then I'm going to go ahead and click OK. And here I go. I have my Alameda sales tax. Pretty straightforward. Once that is done, that's pretty much it. That's how you set up your sales tax. All right. Any questions? Okay. All right. So again, the managed sales tax is how you pay your agencies. But in this case, that's not what our main purpose is. Our main purpose is to just fulfill the sales process. Okay. All right, now that section is over. Last but not least, we have this little section for our reports that we do for sales in general. So let me go ahead and find that section here under sales reports or customer reports. There you go. Okay. Creating sales reports. So again, any report that you create is going to be based on your job position. If you are payroll, you're not going to ever do a sales report. So again, whatever position that you do apply for, whether it is an accounts receivable, accounts payable, HR, whatever it is, or even if you are the general if you are the general accountant, you know, each position has a specific goal in what you're trying to accomplish. So again, the general accountant, their goal is to produce the financial statements, produce financial reports that could possibly do projections or something like that. But for a general manager, a general accountant, you wouldn't want to, you wouldn't have to have the need to look at a sales report for any reason, okay? Unless it's directly correlated to your financial statements. But in this case, most of those things are probably not going to be correlated. So with that being said, you have two options that you can look at. You have customers and receivables, which allows you to look at your AR balance, right? You can even do it based on you could do it the accounts receivable based on the people that you or the customers that are tied in there. You have your customer balance details. You can even have open invoices, which we talked about yesterday. Okay, so again, all of these are going to be something that you have to ask the question, is this what you want to know? And if you don't have those kind of questions, then there's no really a real point to do a report. Now, again, if I'm doing specifically just sales, I can look at projections here. I can look at sales by customer, right? Seeing how much sales of a particular item is actually being more profitable. So in this case, this one's just sales by customer. So this one is not sales by item, but this is sales by customer, which allows me to see who is actually active and who is actually buying my stuff. So as you can see, we have Maria Cruz, we have Bob Mason, and Miranda's Corner. So again, we have only 3 outstanding statement balances, and it's those 3 customers right there. Okay, pretty straightforward. And if you want more details, you can kind of break them down. But in this case, it just only gives you very, very small detail in reports of saying, well, these are the people, these are their sales. Okay. Other ways that you can also look at a sales report is you can even do sales report by item detail or summary. So summary gives you pretty much a summary. So there you go. So it gives you an underlying, oh, okay, well, this is how much money that you're profiting off of this particular item. Okay. This is financial charges. So this other charges. So I gotta make sure that I toggle this. Okay, I want to do sales by item detail, not summary. So there you go. This one is now look at the finance. So this is looking at other charges or other income, of course. But if you actually are looking for a particular one that is more geared towards, so these are for 2021. Okay, so if I were to go all the way back into the past and select January of 2019, okay, and I'm going to leave this till now, right? 3 years fast forward, I'm going to go ahead and click that refresh button. Now this gives you a list of every single item that you actually sell. So again, cameras. Cameras is something that you sold, right? And it gives you a detail, right, on who bought it as well, the invoice, and when did it happen, all right, and how many you sold. So in this case, for my camera, I sold a total of 5. So it gives you a report detail on every single item that you have in regards to sales, okay? So there you go. And it's pretty detailed too. All right. Other reports, I guess I can show you. Let me see. Other reports could be sales by rep, okay? If you have a person who's in charge of their sales, right? Each representative can see how they're doing, all right? So you can choose that. Or if you're the boss, right? You give commissions or you give bonuses for the person who does the most sales. Then you can go ahead and use that report to determine who deserves the bonus and who doesn't. Awful, but that's what you can do. Okay, and then of course you could do sales graph as well, and we'll talk about graphs tomorrow in chapter 6. Okay, so chapter 6 is all about graphs and what you can use with those graphs. Okay, all right. Again, reports are only useful for those who are in the position. Okay, it's not really generally towards a specific goal. Again, if you are in the sense of, you need to know your customers, well, there you go. Print out a customer list. You can do sales by customers, sales by item, etc., etc., okay? So, yeah, that's chapter 3 for you. Any questions in regards to chapter 3?
No.
Okay. So again, I mean, you can practice on opening all the different types of forms so you can kind of look at them. You may do so. I mean, like I said, it's only relevant to you in the position that you're in. So, I mean, feel free to roam around and see what other reports you can do. But again, if you're not in that position, there's really no point to actually really learn it. So if you want to go ahead, just read upon it, and it will give you a description of what each report does. So other than that, here we are. Let's go ahead and do the review questions. Number one, okay, customer statements, okay, what does it do? It gives you a pretty much list of the customer balance detail. Yes, that is true. Okay. Number 2, okay? Which of the following options is not available? Okay, so not available on the available credit window. So after we've completed our credit memo, that window is going to pop up, and it is D. Yes, you do have the option to give a refund. You do have the option to retain an available credit, and you do have an option to apply to an invoice, but you don't have use with receive payments. No, you cannot use a credit memo to pay for something. Sorry, hold on, almost done, guys. Which is all right? I'm gonna hold on. Let me kick her out real quick. Sorry about that.
It's time for a break.
Are you done? Okay. Number 3. Which best way to write off a bad debt? I'm sorry about that.
B.
B. Yes, we're gonna create a credit memo using the bad debt item. Yes, and then you apply it to the invoice. Good. Number 4 says that in which of the following situations would you actually create a credit memo?
B.
It is going to be D, all of the above. So again, when we talk about when you need to record a cancellation, yes. When a customer returns merchandise, yes, that's the number 1 reason why you would use a credit memo. And then C says when a customer requests for a refund. That's essentially the same thing as B. Okay? So yes, all of the above is true, and you can find all of those answers on the very first page of chapter 3. Okay? And then lastly, the credit memo number what should it be? D. It should. Okay, so here's the word should. Okay, it's not. You don't have to, but it should be the number of the invoice followed by a C. So
Easier to track that way.
it's easier to track that way. Yes, it's recommended, but again, keyword is should. It doesn't have to be, but it should. Okay. All right. It's 4:15. So if you guys don't have any other extra questions, again, again, tomorrow is going to be chapter 5 and chapter 6. If we have some extra time, which I don't think we will because we're cramming 2 chapters into one day, I want to try to aim for Thursday to maybe potentially go over one of these questions. So whether it's chapter 2 or chapter 4. So that's just a potential goal. But of course, because we've learned a total of 8 chapters, there's a lot of details in that test prep question that I should go over. So don't put too much hopes on doing the exercises. Again, if you guys can complete them on your own, good for you. But yes, it's encouraged that you guys complete these practice things alone because again, it takes about an hour to do one. So, and right now it's 4:15. So, if you guys don't have any extra questions, you guys are actually free to go.
Have a good day.